That brings us to our talk of the tape as earnings season rolls on. What should investors be watching most closely? Joining us here at Post 9 this afternoon, Adam Parker, founder and CEO of Trivariate Research, also a CNBC contributor. AP, it's great to have you.
Thanks for having me. Good to see you.
Nice afternoon with plenty to talk about as we're approaching session highs here. I want to start with a great note you wrote over the weekend. We basically unrolling the possibility of S&P 10K by the end of the decade based on a lot of the things you're hearing now from, say, tech companies.
You know, it sounds like one of those crazy things where it's 6301 and you think, God, 10,000, this is one of these, uber bullish idiots that comes on CNBC type of thing. But when you do the math, long-term S&P's grown earnings about 8.6% per year for the last 50 years. I think it's reasonable to assume that with all the AI investment that's happening, we could get 9 to 11% growth for a few-year stretch here and get us a little bit above the long-term average. And if you kind of take the price to earnings that we're paying around now, that gets you 2030 on 2031 numbers gets you around 10,000. So it was just to kind of get people. I think the reason the market's been very resilient is because all the investment that happened in AI, we were always told it was going to be kind of a 3 to 4 year before we started seeing it. So one of the things I'm watching, do we start seeing any companies talking about productivity? Microsoft flashed a little last week saying, hey, we save $500 million here. And I think in the next 12 to 18 months, we're going to see more and more of that, and people are going to start thinking, all right, well, earnings can grow 10% in the next couple of years.
So we'd be moving beyond the build-out per se and starting to get some of that return on investment?
I think that's right, and I think if we don't get it, then we're going to have a correction in the market. I think we've seen enough CapEx from the big companies. So what we do at Trivariate is we search every earnings call transcript for any mention of anything related to, hey, we think we can grow our revenue without a lot of net hiring, or we're getting better at predicting our employee behavior or our customer behavior. And the kind of stocks that have worked have been ones where they have low margins, lots of employees. Look at Walmart's multiple and Costco's multiple, and even like in drug distribution, McKesson or whatever. Like these stocks have started to go up not because they're not high margin. They're low, but I can dream of margin expansion, and that's how I get the multiple expansion.
Right.
Yeah.
At the same time, we do have sort of the construction element still in place. Caterpillar today, Eaton, you name it. GE, a good story once again, right?
Totally. I mean, one of the things that maybe isn't obvious to people because the market, as you said, is basically at highs. 5 of the 11 gig sectors have down earnings year over year in the second quarter. So it's not like every single part of the market's, materials, and not everything's clicking on full cylinders. So if we solely get some economic improvement in the industrial side, even if the consumer a tiny bit slows, we'll just get other things working. I think the other thing that is a little bit weird about the S&P, maybe not everyone gets, is...
By the way, as we are now get record highs at 6303.
Yeah, right there, right. So 58% of the S&P is 3 sectors: tech, comp services, and financials. So if you're bullish on the market, you kind of have to own a chunk of those 3. That's the biggest 3 sectors have been in over 25 years. Right? So everyone wants to talk about breadth, but what do you mean? Like the market's concentrated in those 3 sectors and they're big. 4 sectors, utilities, energy, REITs, materials, are less than 9% of the S&P, all combined. So, you can go crazy if you're trying to beat the S&P and own a lot of one of those sectors, but you still own way less than you do in tech. You're going to own way more tech no matter what.
Right.
Yeah.
Still, though, people were looking today at the triple Qs versus the SPY, right? That spread's widening a bit, is it not?
Yeah, I think tech has just so much potential here in the next 2 or 3 years to grow. I mean, if earnings grow 10% a year the next 2 years, do you want to be negative on tech? I mean, that's kind of how I look at it. Like, I just got back from being in London and talking to a lot of European investors, and I think they look at the U.S. and just think, well, the market's expensive versus its history, margins are high, and I want to own something else. And I kind of want to say, yeah, if you go to any perspective on it, like I was going to say, if you go to like a Motel 6, it's cheaper than the Four Seasons. Well, it's because it's worse, right? Like you have to adjust for the fact that there's something somewhat inferior about the set of companies that they have there. Here in the U.S., there's just a lot of high margin businesses growing faster. So I don't think it's the end of U.S. exceptionalism. I like the U.S. tech sector. I think the financials are in great shape. And probably the most contrarian call we have at Trivariate is our overweight healthcare call, where I do get a lot of pushback on, will the AI productivity stuff hit in the next 6 months, or is it more, hey, 5 years from now and it's too early to get in front of that?
Are you talking hospitals, pharma, insurers? Which part?
I think there'll be a sequence. I think drug distribution, diagnostics, hospitals will benefit earlier, tools, and then in the medium term, it'll probably be, more like the drug development side. But I kind of look at it and say, not everyone maybe knows this, healthcare revenue per share for the S&P 500 has grown at least 25 years in a row every year. Right, during COVID, during the financial crisis, there's a lot of old people. They demand services, tools, diagnostics, testing, hospitalization, managed care. So you have somewhat steadier revenue. There are big fears, obviously, when we're running at a wartime deficit in the U.S. Maybe they cut back on healthcare spending, do get rid of drug rebates, et cetera. But I just look at it and think, if you and I were sitting on top of the S&P and we said, where would we focus our efforts for AI? We'd say, where there are lots of employees, where there are low margins and lots of revenue, and let's go there. And so many of those are healthcare companies. So that's why I think there's just, it's not like they're all awesome, it's they're bad and there's opportunity for improvement that gets me more excited.